Welcome to the Business Financial News Network channel. I am Banny, and my job is to relay the latest business and financial news. Carvana announced a debt restructuring agreement that will reduce its outstanding debt by over $1.2 billion. The agreement eliminates more than 83% of its 2025 and 2027 unsecured note maturities, lowering cash interest expense by $430 million annually for 2 years. Additionally, Carvana plans to raise capital by selling up to $1 billion in shares. Following the announcement, Carvana's shares surged over 35% to $53.99, the highest open price in over a year, closing up 40% at $55.80 per share. The restructuring agreement covers around $5.2 billion of senior unsecured bonds, involving its largest bondholder, Apollo Global Management. Creditors will receive new secured notes with longer maturities than the old ones. During the second quarter, Carvana reported a loss per share of 55 cents, beating the expected loss of $1.15 per share. The revenue was $2.97 billion, higher than the expected $2.59 billion. Carvana's net loss improved from $439 million to $105 million compared to the previous year. The total gross profit per unit, GPU, during the second quarter was $6,520, a 94% increase from the previous year. Carvana's CEO, Ernie Garcia, expressed confidence in the company's three-step plan to return to growth, given the positive impact of the debt restructuring agreement and the company's strong execution. Adjusted earnings before interest, taxes, depreciation, and amortization were $155 million, compared to a loss of $216 million the previous year. In other news, Netflix gained 5.9 million subscribers in the quarter, driven by its crackdown on password sharing and the introduction of a cheaper $6.99 per month advertising tier. The company added 1.2 million subscribers in the United States and Canada, the highest regional gain since 2021. In contrast, other media companies like Disney and Warner Bros. Discovery have been cutting content from their streaming services to save on expenses and have experienced significant layoffs to improve cash flow. Paramount Global and Comcast's NBC Universal are expecting record annual losses for their streaming businesses in 2023. Netflix, on the other hand, increased its free cash flow estimate to $5 billion for the year, up from the previous estimate of $3.5 billion. The company foresees about 6 million subscriber gains in the next quarter and anticipates revenue acceleration in the second half of the year due to the impact of its password-sharing crackdown and steady growth in its ad-supported plan. Despite a focus on its new video game business last year, this quarter's shareholder letter barely addressed video games, indicating that advertising is now a primary focus. Netflix's streaming growth, rising cash reserves, and investor excitement about advertising contribute to its steady performance and valuation increase. Although Netflix shares dropped 5% after hours, it is attributed to profit-taking after significant gains this year, and not due to concerns over its quarterly results. Overall, the company has rebounded from a challenging period and remains on track without needing to shift its strategy. What do you think of Carvana's debt restructuring deal? Do you think this deal can lead the company on a path to profitability in the future? Also, what do you think of Netflix's subscriber growth? Do you think this is just the start of benefits of the password sharing crackdown? Let me know in the comments below. Let's get a discussion going. If you want to be updated on the latest business and financial news, hit that like, share, and subscribe button. Take care and have a great rest of your day.